Get started. Thank you so much for joining us. As we typically do, just getting started here at 5:30. Welcome to BRICS Co-working and Innovation space here in Waterville, Maine. Good evening. Welcome ostensibly to January's Tech Night. We're doing something a little bit different, but certainly fun. So for our kind of Tech Night alums, thank you for joining us. For new folks in the room, likewise, thank you for joining us. It's wonderful to see everybody. Central Maine Tech Night is a monthly evening in the Mid-Maine region that brings together technology experts and hobbyists together to network, learn, and share. You can find more information about us on Facebook or online at centralmaine.org at the Tech tab. I'd like to thank our sponsors for this evening. This free event is presented by the Central Maine Growth Council and is sponsored by CGI, Thomas College's Harold Alfond Institute for Business Innovation. Valley Beverage is providing us our delicious cold beverages this evening. And of course, again, thank you to BRICS for hosting us. In addition, I'd like to say thank you to the folks that are watching at home tonight. This Tech Night and this OZ workshop is being streamed live and can be viewed on Crossroads-TV. On channel 1301, so thank you to Crossroads-TV, thank you to Chad behind the camera, and again, welcome to folks at home. So we do have a little bit of a different Tech Talk this evening. This evening's Tech Talk is an Opportunity Zone workshop. Currently, downtown Waterville is home to one of Maine's 32 Opportunity Zones, the nation's newest tax incentive to encourage investment and growth in economically distressed areas. With over $100 million recently invested in downtown Waterville, this project is poised to continue the momentum of current revitalization initiatives. Governed by the IRS, the Opportunity Zone program provides significant benefits to investors, but requires legal and financial sophistication to fully realize its potential. Tonight, we will provide insight on a general geographic overview, insight from Whitfly McPage CPA, and how to maximize tax incentives. As well as the royal we, but also the Central Maine Growth Council is working closely with the IRS on the technical rollout of this locally. The IRS was very kind in planning to attend this evening. However, due to the federal shutdown, they will not be joining us, of course, but I think we're going to see some lovely information, and thank you to McPage as well. Really quickly, a breakdown of this evening's overview. Just provide a little regional geographic economic information. We'll touch on the downtown really quickly, and then we will get into some of the nuts and bolts of the OZ initiative. Before we get started, and maybe just to help us, can I get just a general show of hands? Who is from Waterville or maybe one of the surrounding communities currently? Okay. So a majority. And how about, how many folks have previously, before tonight, really looked at the Opportunity Zone program? Okay, so we have. Thank you, Jim. I'm glad. So there's some a little bit of different knowledge and know-how as well as familiarity in the community. So before we get into the nuts and bolts of the program, I do want to just give a plug for the Central Maine Growth Council. If you're not familiar with us, the Central Maine Growth Council is a 501c6 mission-driven economic development corporation. We are ostensibly honored to serve the municipalities of the city of Waterville, town of Fairfield, town of Winslow, and the town of Oakland, as well as our private sector investors and our institutional partners. This ranges from classic and prototypical economic development services, site analysis, firm recruitment, city planning and policy analysis, and incentive programs as well. Really quickly, more geared towards those that maybe not are less familiar with our region, so you are at 10 Water Street, really in the core of downtown Waterville, one of what I would argue 4 metropolitan hubs in the state of Maine, and the data certainly supports that. A regional 30-mile population of approximately 250,000 people. That, of course, is drawing from approximately a state of Maine population, 1.3 million people. Currently, the city of Waterville has been bucking local, state, and regional population trends and seeing population increases compared to other averages that have been, unfortunately, nominal in growth, as is often categorized in Maine's demographic winter, right? That aging population met by that declining population was at mean a reduction in that working age population. We have been able to buck that trend, which is lovely. To your right is a labor force just indicating some of those data points. My favorite graph of this evening is that population trend of over the last 7 years, population increase by 5.6%. Very hard to find that type of population increase in the state of Maine currently. So, just lastly, before we pass it on, this is Waterville's Opportunity Zone. Show of hands, just who's seen this map before? Okay, some familiarity. For those that have not, really quickly, what you're looking at is a census tract in the city of Waterville, obviously not the entire jurisdiction, but an overlay that includes the downtown. What you see there is a boundary that is defined at the northern terminus of a municipal lot line in Fairfield up here, Waterville down here. The municipal lot line, Fairfield, coming along the boundary of College Avenue, and then peeling off and following the train tracks. We did not draw this. Then following the Messalonsky Stream, coming all the way down, snaking around, following the stream down, coming down the southern boundary, getting very close to Thomas College, and then the southern terminus, entering the tributary into the Kennebec River. Then again, coming back up north, necklacing along the Kennebec River, back up to Fairfield. This, the land use and zoning and the characteristics within are very diverse. There's a milieu of residential, commercial, mixed use, waterfront, and downtown land use, zoning, and characteristics. And this really represents plus or minus approximately 1,000 acres total. So a diverse array of opportunities, projects, land uses, and holdings, and some nice acreage. Just really quickly, I'm not going to get, for several reasons, into any site specifics or building specifics or development opportunity specifics in great detail, but it would be hard not to discuss what is occurring in downtown Waterville, which is also in the OZ zone. And what you see is approximately $100 million in an investment that's occurred just in a short period of time. The red indicating recent investments in the downtown, the blue representing some institutional investments, and of course we are sitting right here in a very compact downtown with tremendous opportunity for growth. I'd like to plug the recent announcement of USDOT, United States Department of Transportation build grant, where the city submitted out of 851 grants, was awarded was one of 91 of those for a $92 million project to really adjust the function and form of the downtown, not limited to modernizing and channeling traffic, making traffic improvements in via conversion of 1 to 2-way traffic on Front and Main Street. Approximately the other 45% of that project going into what I would categorize as a complete street policy or a complete street initiative. Those vibrancy elements, streetscaping amenities, rebuilding of sidewalks, signage, lights, landscaping and design, pedestrian improvements, those vibrancy elements. And then another $1 million going in conjunction with Kastongway Square redevelopment and abutting and in conjunction with the new arts center there. Very exciting, a lot of activity and a lot of opportunity. Just a closer rendering of what that art center conceptually, what it may look like, and Kastongway Square Park, which is being redesigned, redeveloped, including some of those monies going in there. Some of these cultural and creative economy elements that are so important to a thriving downtown and to create that residential density. Again, a little bit of a shameless plug, tremendous food service and accommodation options, as well as one of my favorites, Waterville Brewing Company. So for those that are thinking about an investment, you're looking at a marketing analysis, you're looking at population, you're looking at businesses, you're looking at people that may want to live, work, and recreate downtown. Not a comprehensive list, but certainly some of the greatest hits. Just very lastly, in case folks weren't familiar, just a quick spotlight on what that business profile looks like. This is actually for the entire city. I just want to be clear on that. But I have peeled out a few businesses that are in the opportunity zone and hopefully kind of reflect that transition from a post-mill and manufacturing milieu to a tech-forward, innovative economy. At the top, you see one of a new company that just came to town, GTCA, a biotechnology company that is actually upstairs since this summer. That is a spin-out of Jack's Labs and IDEX principles. CGI speaks for themselves. Probably the largest tech company that you've never heard of that we continue to be thrilled to work with right on Main Street. And then another favorite of mine, right on that Fairfield municipal boundary that we pointed to, Huhtamaki. So with that said, yeah, please.
Will these be available to us as handouts?
Yeah, thank you. Great question about availability of information. Everything will be available. You'll be able to go back and make notes online, look at it on YouTube. If you prefer just us emailing you a slide deck, we can do that. And I think I forgot to mention, we do have 2 little takeaway handouts up front here as well. As it relates, I don't want to speak necessarily for Jim, but we like this to be casual and collegial. We'll keep some time for some questions at the end, but I'm guessing it's always more fun if there is a back and forth and people do have some questions. So with that said, I'd like to welcome in Whitfly, McPage, and Jim. Thank you so much for joining us on an overview of the Opportunity Zone program.
Oh, thank you.
Just forward, back. Yeah.
Great. Thanks, Garvin, for the introduction, and actually that was very informative for me. I'm from our South Portland office, so that was some education for me in terms of the Waterville area. But like Garvin said, my name is Jim Cardosi. I'm a tax manager at the Whitfly McPage's South Portland office. We've also got an office here in Augusta. I'm not going to touch on any specific funds necessarily or specific geographical areas. I'm going to focus more on an overview of the program, kind of all the moving parts and what the requirements are to meet the different certifications and thresholds that need to be met to take advantage of the benefits for investors who decide to invest in one of the funds. A couple things I think worth mentioning, and like Garvin said, if you have questions or I say something that's not clear, please feel free to interrupt, ask a question. Definitely, keep it casual. A couple things that aren't on the slides. There's still a lot of questions around these that we don't really know yet. It was included in the Tax Cuts and Jobs Act that was passed about a year ago now, back in December of 17. The proposed regulations came out in October of 18, so what's that, maybe 2.5 months ago. There was a public comment period that just ended There was I imagine a pretty significant number of comments that were received, and Treasury was actually supposed to have a hearing on those comments today. Unfortunately, with the current situation, that was canceled. We don't know when that's going to be rescheduled. Hopefully soon, because there are still a fair number of open questions, and some of the tax benefits, as we'll kind of see here, can start to diminish after 2019 if investments are delayed. So hopefully that hearing will be rescheduled soon. And I think there's a handout here that I can hand out if people want it. It might help during the presentation. But with that. So just very high level, opportunity zone. The big picture goal is to connect low-income census tracts or census tracts that are adjacent to low-income census tracts with new long-term capital investment. There's been studies that have looked at the unrealized capital gains that either individuals or businesses are sitting on, and it's in the multiple trillions. So there's a lot of potential investment out there. And the Opportunity Zones is another program for investors to encourage them to recognize some of those gains, get the tax benefits of deferring them and potentially completely excluding some of the gain. But it is, you'll see that the long-term investment is sort of emphasized on the slide. It is a long-term program, and you have to be invested in it for, for a while to see the benefits, and we'll get into the specifics there. So I guess kind of how I'll approach most of the discussion is this is a blank version of the handout that you're getting right now. There's kind of three, I guess, levels of activity, I would call it. You've got up at the top there, you've got the investor who has the capital gains, and we'll see who can be an investor. It's not only individuals, it's businesses and other types of entities as well. You've got the individual or entity. They'll invest in a fund, so there's different requirements that an entity has to meet to be considered a fund. And then the fund invests in qualified opportunity zone property, which can essentially take three forms, and that would either be stock of an opportunity zone corporation, partnership interest in an entity that's organized as in a business opportunity zone business that's organized as a partnership, or the fund can invest in qualified opportunity zone property directly, and that's the third type. And there's some different requirements for each one of those types of property. So we'll get into that now. So who can invest in these? It's not only, as I mentioned briefly, it's not only individuals. It's pretty wide open in terms of who's eligible to invest. It's individuals, corporations, CNS corps, partnerships, single multi-member LLCs, estates and trusts. There's some maybe lesser common entities there, ownership funds, settlement funds. So it's pretty open and flexible in terms of who can actually be an investor in one of these funds. And then the big requirement, though, is that you have to have capital gain. And in this case, capital gain is defined as essentially income that's treated as capital gain on a federal tax return. So you've got your standard, I own stock in Apple, I sell it, I have a gain, there's capital gain. But if there's any tax geeks in the room, you might also recognize Section 1231, unrecaptured 1250. That's gain that can be incurred on sale or disposition of depreciable business property or real estate. It's not necessarily capital gain like we think of capital gain, but it's treated as capital gain on a tax return. So those count. Yes.
So you can't just take $10,000 from your income and put it into one fund.
There's a slide on that. The answer is yes, but you don't get a benefit from it. So a very common question. Jumping ahead a little bit, if you do that, say I had $100 of capital gain and I have 10 grand sitting in a checking account that is burning a hole in my pocket. You can put in the 10,000, but you don't get any step up in basis and you don't get any exclusion on the back end. So you can do it, but there's no benefit to doing it really. You got it as two separate investments.
This would seem to be natural for Wall Street investment banking firms or private equity firms, hedge funds, and others who have had capital gains in 2018, basically to set up these funds for investment. Is that where it's coming from? Or the CEI, is that a potential?
I'm not familiar enough with specific funds to really say where it's coming from, but I think you raise a good point. I think that's definitely a source, probably.
Real simple way to pitch it. I got buddies that sell stock. They're going to get capital gains. I can funnel that money into this area, right?
Yeah, you just have to find a fund to invest the gain in.
Okay.
Yep.
Can you create, are there qualifications to create the fund?
Yes, and I'll talk about that kind of as we go along, but yeah.
But I would say, it seems to me that you have a definite horizon here as to how long you could make the investments, because don't the capital gains have to be paid, especially the short-term capital gains, don't them have to be paid in that same year? They have to be paid by the last quarter of 2019 for capital gains in 18. So wouldn't those investments have to be made during that period?
Right. So basically, you have 180 days to, and we'll cover all this too. But it's similar to a 1031 exchange in terms of time frame. If you have a transaction that gives rise to a gain, you have basically 180 days to defer it, or to choose a fund to invest in, and basically you make a deferral election on a tax return.
Well, I see. So you would, but by just investing in the fund, basically that handles the requirement essentially for that investment, rather than making it into an actual property.
Right, you have to go through a fund, and the fund then goes into the actual property, or the fund invests in a business that acquires the property.
Doesn't the fund have to be, you give your money to a fund, the fund can be you and your wife,
Right.
but as I understand it. But you invested into the Wall Street XYZ fund, and they raised $500 million. They got to do something with that money, just like you got to do.
Yes.
You just can't sit and put it there for 2 years.
Right.
They got to do something with it in a qualified zone within 180 days.
Yes, correct. So there's a certification. You self-certify. The fund self-certifies. There's a form. It actually just got released on Monday, I believe. To do that, you get tested basically at the midway point in the year and at the end of the year. You have to have 90%. And I'm jumping ahead a little bit, but the fund has to have 90% of its assets invested in qualified opportunity zone property.
By the end of the year?
Yes, but there is a working capital exception for like real estate projects and stuff that takes time to kind of mature. So there's some flexibility. We don't necessarily know what the penalties are, or kind of what the specific implications are for not meeting those.
So those regs haven't been written yet?
The proposed ones were issued in October. They were supposed to have a hearing on them today, got canceled. So the final ones have not been issued yet, and we don't really know when that's coming. So, yeah. Do you have a question? Oh, okay. Okay, so I think that's. One other thing with the gain, it has to arise from a transaction with an unrelated party. So I can't sell, if I had a condo somewhere, which I don't, but if I did, I couldn't sell it to my brother, realize this huge gain, and then invest it, because I'd get caught in these related party rules. And it's usually a 50% threshold when you're looking at related parties in terms of entity ownership. It's a little bit more restrictive here. It's 20%. So that's just something to be aware of when you're working in this area. And then kind of to build on the last slide, the gain, it can be stock investments. You can sell a vacation home, a rental property, when you liquidate a corporation, if you have gain on goodwill. It can come from a variety of sources. It just has to be treated as capital gain on your tax return. So again, very similar to like a 1031 exchange or a like-kind exchange, if there's any tax geeks here. 180 days from the transaction triggering the gain. Unlike a there are some fairly significant differences between the Opportunity Zone program and a 1031. The 1031, you have to use all the proceeds. If I get $2 million for a property, I have to roll all of that into my next investment in a like-kind exchange. With the Opportunity Zone investments, it's only the gain. So you could have a gross of $1 million, but if only half of that is gain, you only have to, and you don't even have to invest all of the gain. You can invest a portion of it, or you can invest all of it. A couple other items to note in terms of comparing and contrasting with a 1031 exchange. There's no like-kind requirement. The like-kind exchanges, as the name would suggest, has to be business property for business property. As of 2018, those don't apply to tangible property anymore, so I can't trade in a car or an airplane. It has to be real estate for real estate. There's no like-kind requirement with opportunity zones. The taxpayer can have use of the money. So if you have a gain in June, I can keep that money in my account till September and then decide to defer it. You don't have that option with a like-kind exchange. You have to use a qualified intermediary to hold the funds, or else you blow the transaction. So there are some pretty big differences. The one bullet there that talks about gains that don't have a specific transaction date. An entity or an individual can choose to defer and invest in a fund. So if I was a partner in a partnership, say, and that partnership had a transaction in July that gave rise to capital gain, I may not know about that. So if the partnership chooses not to invest itself, the gain will get passed out to me. I'll find out about it on December 31st or whenever I get my K-1 from the entity. So my clock doesn't start till December 31st. You can elect to start it earlier if you really want to get into an investment, but there are some flexibility around that when you may not know if something's given rise to a gain. So benefits. So when you make a deferral election, you'll defer it until either you sell or transfer your investment, or December 31st of 2026. So we'll talk more a little bit about that date. But basically, you're going to get taxed on at least 85% of your deferral on at the end of 2026. The character of the gain, whether it's short-term, long-term, 1231, whatever character of the gain carries over, but it gets taxed at the capital gain rate that's in effect at the time it's taxed. So if I had a long-term gain that I deferred in 2018 and I get taxed in 2026, if the long-term capital gain rate changes, then that's the tax rate that will be applied to it. The character will stay the same though.
How do compounded gains work? So if you have 3 gains within this period, one property, next property, next property.
So you could elect to defer, and I believe the right answer is that you can elect to defer. So you can only have one deferral per transaction. So you'll report all 3 of those gains. And if you make the deferral election for all of them, then I think that's okay. You can't make multiple deferrals on a single transaction, if that makes sense.
You can go one transaction, defer, next sell that.
You have to sell the entire, so like if you invested into a fund and then you sold your fund investment, you have to sell the entire investment,
okay, or
else you run into that one deferral per transaction rule. And then, if you had a transaction and you say, well, I'm going to put, I'm going to invest half of it. A month later, you can say, oh, I'm going to invest the other half too, as long as you're within that 180 days, and as long as you haven't filed a return that where you've indicated your deferral. So that would.
So if you put in some in January right now, and you get 180 days, you have to do something with it within 180 days. Let's say you put some more in, and then so that's sort of like one identifiable mass of money, a gain. So then you'll say in April, you put another hunk of money into a fund, perhaps the same fund. Is that problematic, or can you just keep that second hunk of gain as its own?
Are these different transactions, or is it one?
Transactions.
Okay. Yeah, I think that's. I think that would be fine. You're going to report each transaction on a tax return, so I think if you just make the deferral election for each one of those, then you're. Does that answer it?
Yeah, no, it's a little tricky. I sort of envisioned it as a pool of water with one ship landing in it, okay? And then you got the same, so then the first question is, put another ship in that water 3 months later. So now you get 2 ships in the water. One's got to be invested in 180 days from putting money in, the other one's going to be invested. You do them in the same fund, in the same pool of water.
Yeah, I don't think there's an issue with investing I have 10,000 a gain 1 month. In month 1, I have 10,000 a gain in month 3.
They both are on the same time.
I think they'd each be on a separate time track.
I mean, their own separate time.
Yes, that's what, because it's 180 days from the transaction date giving rise to the gain. So I think they would each
The
be.
nightmare accounting problem for these big funds is all these ships are going to be coming in, and they got to get that each one of those identifiable ships out of that pot.
Or 12/31/2016.
No, they got to get it out in 180 days. They got to do something with it.
Well, not the fund. Well, not the fund necessarily.
Out of the fund, they got to do something.
They got to invest it.
Yeah,
but
they got to do something with that.
yeah, and there's
It's just that you got to do something within 180 days.
you have to invest. The investor has to put it into the fund in 180 days. The fund has essentially 30, and we'll talk about this a little later. The fund essentially has 30 months to double the investment, or there's a working capital grace period to as you're planning. And that's probably one question that we don't really have a solid answer on in terms of how that 30-month period works.
To turn that around.
Right,
That's all.
basically, yeah.
They've got to do something with it, you're saying, within 30 months.
It's that you've got to meet the substantially all requirement of having either 90% of your assets in opportunity zone property, or if you're a business, 70%. So yeah.
Not only do you have to do something with it, you actually got to do something and do that
Within
percent additional investment that we're going to talk about later.
Yeah.
You got to put it in some investment, and you got to do something with that investment.
the investor has to put it in the fund has to do something with it.
And the fund has to do its thing within 30 months, right?
Yeah, essentially. Yeah, the fund's not the 180 day. The 180 days is on the investor side.
But hypothetically, on the one house, just slow, make sure I understand. I go out, you're my manager, right? Like you're investing into my fund. I go, once he puts his money with me, I have 180 days. No,
Nope. He's got
I get it to you in 180 days.
Get
Yeah.
me in 180 days. Then from that 180, I get 30 days to flip the house.
No, 30 months to, and again, I think that's still one of those things that's not totally fleshed out. But yeah, and later on I might address
The
that.
next point you're asking, so let's say you go out and buy a piece of property, an old mill building, a piece of land. You got to do something. You have not only have to go buy that,
Right.
Get the area.
property. You got to do that substantial improvement.
And we'll talk to the original use versus substantial improvement
You just can't park
thresholds.
money not doing anything.
Yeah.
So it has to be placed in service then within 30 months.
Yeah, basically. Yeah, I think it'll be clear later, in a little bit. We're jumping a little bit ahead, but oops, and I'm breaking things. No, but that's all good.
Thank God the IRS guy isn't here.
I know. I was actually hoping they'd be here because they might be able to answer some of these.
Would they even be able to answer the questions since the regs
Who knows how much involvement they've had with it, and the regs aren't finalized yet. So. Okay, so sort of getting to the incremental benefits. So let's say, and there'll be an example later on, but basically if you hold it for, your initial basis is zero because you're deferring you have zero basis in the gain that you've deferred. If you hold your investment for you hold your fund investment for 5 years, you get a step up of 10%. So if you invest $100, 5 years from now, if I still own it, my basis is 10 instead of 0. 2 more years, you hit the 7-year mark, you get another 5% step up. So now my basis goes from 0 to 10 at 5 years, 10 to 15 at 7 years. So on December 31st of 2026, I'm going to get taxed at the at the capital gains rate at that time on the remaining 85. And then if I still have my investment at 10 years, then you can elect to treat your basis as the fair market value, which essentially allows you to exclude any post-acquisition appreciation. And then the certifications expire at the end of 2027, but that doesn't preclude you from not getting that fair market value step up. But you do have to dispose of your investment by 2047. So it doesn't go forever, but that's 30 years down the road. This gets back to your question, I think, about the non-gain investment. You can do it, but there's no deferral, and you don't get the fair market value step up later on down the line. So you can do it, but you're not eligible for the benefits. Like we said, this kind of rehashes the prior slide. Your initial investment is zero, or your initial basis is zero. You get a 10% step up after 5 years, another 5% after 7 years, so 15% at the end of 7 years. And then just kind of, again, a little bit of a rehash also. You're going to get taxed on that remaining 85%, either when you dispose of it or December 31st of 2026, whichever is earlier. That brings your basis up to the amount you've invested. If for some reason the investment decreases in value before that 2026 date, you're not taxed on that full 85%. You're only taxed on the fair market value over your initial investment. So always a good idea. You'll probably see a lot of valuation requests maybe at that time, because you want to see what it's worth, so you're not paying tax on too much tax at that point in time. So that's a nice thing for investors. One other thing that did you have a question, sir?
Well, I was just thinking that, in 2026, suppose the tax rates are basically 80, 90, 70, or 90%, like some people want, then basically that could be a real kick.
It's tough to do planning nowadays. It's
no guarantee.
Yeah, it's very.
Now, it's nothing.
I mean, it's the same way with people are looking at converting, C to S or C to LLC, LLC to S for the reduced rates and the pass-through deduction. I always caveat it with saying, you get a different administration in a couple of years, and who knows? So, buyer beware, I suppose. But just in terms of pass-through entities and investing in these, I think it's worth mentioning. We don't really know how if you're an investor in a partnership, you get your basis increases for income and contributions. It decreases for losses and distributions. So we don't know necessarily right now how that's going to interact with the zero basis. And the initial investment, that's something that hopefully will be answered in the final regulations when they're issued. Okay, so just an example maybe to kind of collect what we've talked about so far. So in January of 18, you've got $1 million capital gain. June 30th of 18, within 180 days, an investor will invest that in a qualified opportunity fund. You've got a zero beginning basis, and then the fund invests $1 million, like we were talking about earlier, in qualified opportunity zone property. So 5 years, in June of 2023, you hit your 5-year mark. Your basis now goes up to $100,000 because I get a 10% step up. June of 2025, I hit my 7-year mark. My basis goes from 100 to 150. I get an extra 5%. So now my basis is $150,000. December 31st of 2026, time to pay the piper. The $850,000 of deferred gain is taxed at whatever the rate on that type of gain is at that point in time. Because you're paying tax on it, your basis now goes from the 150 all the way up to the $1 million that you originally invested. And again, confirm the value of it in the event that you think it may have gone down in value. So then, June of 2028, I hit the 10-year mark. I can elect for my basis, so let's say in 2028 that my investment, the value of that has gone from $1 million to $2 million. I can elect to make the fair market value my basis. So it doesn't say it, but essentially if I sold it the next day, then I walk away with $1 million tax-free because I just stepped my basis up from $1 million to $2 million.
That's the real.
Yeah, and that's they want people to come in, spend money, and stay long term. So that's the real benefit if you can stick it out. So now we're kind of switching gears from the investor to the actual fund. It can be a couple different entities. A corporation, I haven't seen anything that says it couldn't be an S corporation. So right now that's, I think, a viable option. Partnership or an LLC that's taxed as either a corporation or a partnership. It's got to be organized in one of the 50 states. Just because it's organized in one state doesn't mean it can't invest in something in another state. So there's some leeway there. And then just has to be formed for the purposes of investing in qualified opportunity zone property. And we'll look at the 3 types of that. They're on your handout, and we'll look at those in a little bit. So here's where the thresholds kind of kick in. The fund has to have 90% of its assets in opportunity zone property. It gets tested essentially halfway through the year at the six-month mark, and then at the end of the year. And then again, I don't know exactly how this is going to work. I think it's yet to be determined, but you'll get penalized if you don't meet those 90% that 90% threshold. And then what it would take for a fund to lose its certification or status, I don't think it's quite been answered yet. And again, I think I mentioned this earlier, but the fund will self-certify on an 8996. That form actually just got released on Monday, I believe. It's got to identify, amongst other information on the form, it's got to identify the first year that it wants to be a fund, and it's got to identify the first month in that year that it's going to be a fund. That's important because you want to watch that, because if you invest in a fund before that first month that it's certifying itself as a fund, then there's no benefits. So you need to make sure it's actually certified. This slide, there's a website by the National Council of State Housing Agencies that's got, I think this says 34, that was in November. I was on it the other day. It looks like a fair number more than that. But these are just national funds. It's got them organized by name, size, area of the country they're focused in, what they're investing in. I don't think this lists any like state level or regional level funds. So just, be aware that that's a source if you're curious. So kind of shifting gears again, we looked at the investor, we looked at the fund. So the zone, and we've kind of already hit on this a little bit, but generally a low-income census tract or a census tract that's contiguous with a low-income tract. All the governors of the states proposed these back in the spring. Treasury certified them. There's 32 in Maine, I believe. New Hampshire's got about 20, I think 27, 28. Mass has about 130, so there's a lot in Massachusetts. They vary pretty widely across the country in terms of geography, urban, rural, different types of use. What was I going to say? Yeah, there's a map if you have access to the slides and you're curious to look at the map, there's a map of all of them at that website there.
So there's thousands of zones, but
Yes.
34 funds.
No, those are just the funds that were on that site that are like national. Those are probably the bigger funds. There's, who knows how many funds there ends up being. Yeah, you could. Yeah, it just has to be, you've got to be a partnership or a corporation, and you've got to meet the 90% test in terms of where your assets are invested. But yeah.
8,700 across the country.
Zones.
32. So you can see how many.
Yeah, there's a lot of them.
I assume that multiple funds could make investments into a single project.
Yeah, I would think so.
I assume a fund can make multiple investments into multiple zones.
I would think so, as long as 90% of your assets are in zone property. I don't think it would depend on, I think you could do multiple. So just kind of so now we're kind of shifting into what constitutes the zone property. So you've got the fund, and then like is on the handout, and I think we alluded to, there's 3 types. It's a partnership interest, stock of a qualified opportunity zone business that's a corporation, or the fund just invests in the property itself, kind of like rather than having sort of an operating sub, the fund is the business, essentially. So some of the requirements for the stock or partnership interest, it can be a new or existing entity, but it has to be acquired after the 31st of December of 17. So now, it's got to be acquired for cash. It can't be you can't provide services or property in exchange for your interest, and it's got to be original issue. This gets back to the new investment that they want to generate. You can't, if somebody's retiring or getting out or selling their share, that doesn't count. It has to be new investment, and you have to put cash in.
And it'd be leveraged though, so if somebody comes in, can you leverage this whole thing?
I don't think so. I think it's got to be pure. I don't think debt. I don't think you can do that. I don't believe that's allowed.
So you cannot invest, you don't qualify to invest in an existing entity or structure that's in the book. Well, you can obviously invest in an existing building.
Yes.
So you invest in an existing corporate entity in the zone.
Yeah. It can be an existing entity.
Yeah.
But if it's an existing building, like this might be tough to invest. If this was, I don't know if this is, I think this is in the zone. So this might be tough to invest in because it's been developed relatively recently, and it wouldn't meet the original use standard. So you'd have to substantially improve it, which essentially requires you to double your investment. So it encourages sort of older, not recently developed property or bringing new property into a zone.
So the original use standard you're talking about, so if XYZ Corporation was, say, didn't even own real estate, just were a corporation leasing space in the zone, and they're running $1 million annual income company, selling shoes or something. Mm-hmm. So the zone money, the opportunity zone money comes into that to be invested in that existing shoe company. And then what happens? Well, keep it qualified.
You've either got, so the fund, if the fund acquires interest in that entity, then the entity's got to meet, and I'll kind of get to that too, but the entity's got to meet, the business has to have 70%, substantially all of its assets in qualified opportunity zone business property, which has to be acquired after 2017. Or else it doesn't qualify. So basically, they would have to substantially improve that. So they'd have to substantially improve that property because it's already been used inside the zone.
So we're kind of talking physical property.
Yeah.
So you cannot invest in capital in the company which is used to expand the company and hire more employees.
It's got to be business, tangible property. It's got to be property, real estate, buildings. Land doesn't qualify for, and we'll see. Land doesn't play into that calculation. But yeah, it can't be. You can't go out and just hire more people. It's got to be looking at your balance sheet or your cost per asset. It's got to be property.
Your business leases property. You don't own the property.
Well, it is owned or leased, I think, is how it reads.
You lease the property. You can obviously improve the leasehold,
right,
but you don't get there by hiring those new employees.
No, I don't think so.
Frankly, it would be helpful because we hire people.
Well, and I think that's one of the potential criticisms of this is who's going to benefit. If you come in and are property prices going to go up, and are you going to push out lower income people? Do the jobs that come in, do they align with the skill sets that are in the community? So, yeah, I think that's some of the criticisms of this type of program.
But the real purpose is it's essentially just to reinvigorate properties like you have in Waterville that need work.
Yep. Yeah. I think, yeah.
That's the idea.
Yeah. And the idea, and then you've got the good space. Businesses will come in. People will get hired. I think that's.
Yeah.
But yeah, the goal is really to infuse capital investment into the community.
Yeah.
Mm-hmm. Yeah. So I think this might get to your question. What's the property? Property is using the. Tangible property used in the trade or business. It can be owned directly by the fund or by the corporation or the partnership that the fund invests in. Just another bullet on the related party rules, and the property has to be acquired after December 31st of 2017. So again, that new investment emphasis. So it's got to be original use, so it has to be you know, I buy, you know, I have, you know, whatever factory, I bring in a machine from, you know, outside of a zone into a zone. It's used property, but it's the first time, its original use in the zone starts with me, so that would qualify. If you don't meet the original use, you've got to substantially improve it, and we'll look at that. So again, original use, newly built in the zone, or new or used property brought into a zone. So again, like we were sort of getting at, this is really to encourage like vacant or underutilized distressed areas. Land, obviously, original use was with the dinosaurs, so that doesn't apply to any of these rules. It's just the property.
So that's, I just don't want to keep on asking questions.
No, it's okay.
The biggest question I've heard from the real estate side of things is, it's pretty simple. If you, as I understand it, you say you buy a $1.5 million piece of real estate that breaks out as tax assessment forms, as a appraisal, as $1 million worth of dirt,
Yep.
and a $500,000 bill. The dirt gets left out of the calculation.
Right. So you'd have to spend another $500,000.
Right.
You the land doesn't count.
Okay, so so I guess maybe the simple answer to the big question is this: what if you buy a piece of property that's only dirt? It's a vacant lot.
I don't know. So I would think that.
That's a huge question.
Yeah, and I don't know that it's been answered yet, honestly.
Because the thing is, what you do in that first model I gave you with a $500,000 structure, when you do that 50% improvement and put another $500,000 into that, you bring the whole $1.5 million you put in plus the half you invested.
Right.
You got a $2 million deal.
Right.
So it's a huge. So that is the question. What if you? The example I read is, you go buy a gravel lot, right? Jesus, it just happens to be next door to a new stadium.
Right.
Best goddamn parking lot in the world.
Yeah.
All you got to do is put up a $1,000 hut to collect the money, and the whole. Theoretically, if they don't straighten this out, maybe they won't.
Yeah.
That hut drags the whole property in.
No, I think the way it's currently written, that's probably right. I haven't read anything to the contrary. I don't know. I mean, I can follow up on it, though, with one of my colleagues and see if...
That would be a very big question.
Yeah.
Well, that's why everybody's kind of waiting for these fucking rules to come out.
Right.
So is that theory saying that you could basically park that and defer your taxes?
You got to do something, but the question is how much you
have to spend.
Right.
Yeah, and land doesn't get included in the substantial improvement calculation, so that's a good question.
Yeah, if you heard that you've got a sort of the test for substantial rehab is the same as the historic preservation test, 50% movement, 50%. Put as much into the building
as you paid for it. So like 100, you double it, yeah. Essentially.
That's if you heard that, that's going to be the test.
As far as I know right now, that's the test. You have to basically double your investment, and you have to double your basis, yeah. But no, the land I think is still out there for to be answered. Yeah, and here's the substantial. So if you don't meet the original use, you've got 30 months basically, and we don't know necessarily when or how this 30-month is tracked. I think that's still an outstanding question to meet that test. So that's that. So then just qualified opportunity zone business. The business has to be owned or leased. It's got to have substantially all of its assets is qualified opportunity zone business property. 70% is the threshold as it's written right now. 50% of the gross income has to be from an active trader business. So getting back to real estate, triple net leases generally don't constitute active trader business, so we don't necessarily know how that active trader business is going to be defined.
Could you break that down? I don't think you're interested in that.
So it's section 162 in the Internal Revenue Code defines like active trader business. Essentially consistent. Basically, you have to consistently be involved in running the business. And a question I think is probably for in the real estate community is triple net leases. Basic. If you sit back and collect a rent check, those generally don't qualify as an active trader business. So potentially, we don't know exactly how they'll be treated.
Okay.
as far as that goes. And again, the substantial intangible property, I don't think we know what that means either. I think in terms of substantial, the only one that's really set now is that 70% of the business's assets have to be in opportunity zone property, which has to meet that definition of, acquired after 12/31/17, substantially improved or original use. Yep, and then again, less than, this just goes to that, what you're doing with the assets. Cash equivalents, you can't have more than 5% of those be in that medium. There's a working capital exception because some projects take a while to mature. And basically that requires you to have a written plan for what you're gonna do with all that cash that was just invested. You've got to have a schedule. You've got to basically prove that you're working towards meeting that goal within that 30-month, and it's actually 31 months, I think, for the exception. So that can help alleviate a little bit of that initial. We've got a lot of cash, but maybe not a lot of property up front. A couple businesses are disallowed, essentially. Golf courses, country clubs, massage parlors, liquor stores. Racetracks, gambling facilities. Those don't qualify for the program. And then just sort of a graphic to wrap everything up. Investor with the gains invests in the fund. The fund invests in corporate stock or partnership interest of a qualified opportunity zone business, or they just invest directly into the property themselves. Caveat there. And then I think that's essentially all I have. Unless there's any questions.
Sure. If you mentioned that triple net leases basically don't qualify. If you're an owner of a property and basically your returns are coming through triple net leases or rents, essentially, wouldn't that qualify?
So, I'm sorry, I didn't catch the.
Well, if you own a property, basically, and you're renting that property, and then essentially you have a triple net lease, which is pretty common, basically. But the rents that are coming back to you, would that qualify?
I don't think I could say for certain right now because we don't know how the active trader business is gonna be defined. Generally, triple net leases don't meet that threshold, but if maybe it's written as a triple net lease, but you're doing all the repairs and you're in charge of interviewing tenants and whatever else.
You're spending millions of dollars essentially to renovate that building.
Yeah, then the argument could be there, but it's just.
So then it would be more inclined to be like if you were in a manufacturing situation. I mean, you have the building, you're renovating the building, and you're using it for your own purposes, basically to manufacture something.
That could be better off. That could be better off, but
I think it sounds like it's to be determined.
I think it is. I think there's a lot of questions around real estate and the 20% pass-through deduction as well. So it's kind of a sticky area. So yeah, I think we just need a little bit more guidance on it.
So you're saying basically then just do a standard real estate deal. I got buying this place, I'm rehabbing it. I'm going to lease it out to some insurance company, triple net. That's possibly problematic.
Could be if it's written that way.
We just don't know until we see what.
Yeah, we don't. Technically, they typically don't meet the active trader business, but.
Oh, that's because that's based on a previously existing.
Right. Yeah. We're just sort of We're sort of speculating.
Yeah. A person asked me a very specific question about solar, electricity generation, renewable investments. So you buy a piece of land, and you drop $1 million worth for $1 million. Buy a piece of land for $200,000, you put $1 million worth of solar panels on it. What do you think?
is it part of a bit, you know, are you generating electricity first? You know, I guess, is it a bit, you know,
It's active.
yeah, I
Just a joke about
yeah,
that.
could,
Is it, if it was to export, is it?
yeah, I mean, well, you know, are you selling it to somebody, or?
Yeah, you're selling it into the grid.
Yeah, probably. I don't know.
Full scale power, I wouldn't
Yeah.
be surprised if that was the case.
Yeah.
But utilities often are
Regulated and statute differently,
That's a good
so
point.
So that's a great, that's sort of.
But you would be an unregulated utility, you sell units and.
Well, you know, that's all, those questions are all answered, you know, already in the DEC regs and all that. I thought about you generate electricity just for the business you put on the property, then that's pretty easy, but
Yeah.
you just do a straight up solar array.
Yeah, I don't know.
See, because you don't have this employment test.
Right.
You just got to put, you're going to
Yeah,
improve
it's
the
just-
property and you're going to generate
50% of the, yeah, 50%
and
of the income.
You're adding tax value for the community, which is, I'm sure, part of the public policy
Yeah.
interest there.
Yeah.
Generating taxes for the community. That's part of the benefit.
Yeah.
Oh, yeah, yeah.
That's part of the purpose of this.
Yeah. Yeah, and I mean, it would help to get guidance soon, because if you don't, you know, you lose that basis step up as you get past 2019, because you get closer to the 2026, so you can't meet the 7-year period and the 5-year period eventually, so.
So every investment that you have, if you start a fund, you couldn't go and get $100,000 and then leverage that into whatever else. So you can't use debt as a vehicle.
It's got to be equity.
Well, you can put the debt in right beside the fund money, right? It doesn't have to be exclusive, does it?
No,
Well,
exactly.
Yeah.
yeah. Yeah, I'm not sure.
Something to look into deeper.
Yeah, I think so.
So if you're a regular Joe looking at like a brokerage firm like Charles Schwab or like Robinhood, like buying these funds, it's still in the infancy now where they're probably not readily listed as like opportunity funds like REITs are, or
I mean, honestly, I'd say probably talk to like the community development folks. They're probably more in tune to.
I don't want to get into too much detail tonight, but we're in a process of at least one OF currently, and then probably the question is, would you want to create your own as well?
Yeah.
Which then begs the question, you'd have to have counsel essentially work with you and
Yeah, I mean, I would say certainly talk, you know, based on your specific facts and circumstances, you definitely want to review that before you do anything.
And someone told me that the first wave here is private equity funds where they got their own money. So you get
Yeah.
Goldman Sachs, let's say, and they $2 billion, and they've got guys roving around looking for places to put it. And they're not taking investments from doctors, lawyers, business people who've got money to invest. They're not pooling it because there's too much risk there to the people whose money you're taking. If you screw up, you got a serious problem.
And because we don't know a lot about, you know, there's still a lot of open answers.
So these private equity funds are just scouting around, putting some money in, but waiting for these final rules.
Yeah.
Then the next wave is going to be these smaller, oftentimes community-based funds. But the one to worry about here is the fraudulent kind of scam artist who puts together a fund and has no friggin' idea what he's doing. And it's an accounting problem we just talked about,
Yeah.
of the 90 days and 180 days and all these other issues. If they're not well managed, they screw up. And all of a sudden, the guy calls you up someday and says, "You know what? We just lost your entire
Investment or
and your step out."
How's that any different than Wall Street? Right? So,
Well, I don't know.
I may give my money to you and actually trust you more than
I don't trust
on Wall Street.
I'll just say this. I was talking with a real estate person the other day, as an investor, and she said, "Well, I'm just going to tell you this much." I said, "How much activity have you seen around Boston?" She said, "I'll just tell you this much. The cap rate is there's a zone in Revere, Mass, somewhere down there.
Yeah.
The cap rates for properties in Revere, Mass, in that zone have dropped about 1.5 since this whole thing started. The value of property's gone up in that zone, and I'm just saying, you know, Revere, Mass has kind of got some other characteristics that, you know, really creative investment, shall we
I
say.
feel like if you want to start one of these, like I got a couple friends who are selling stock, start one, know that you're going to have upside anyway, right? And then try to work out the legal kinks along the way if you're going to do a locality.
Yeah, I mean, I don't know. I'd want a little bit more assurance
If you
before.
started it, right, so let's say that you're already gonna invest in these properties, right? You're already gonna cash flow them and prepare them. Then the tax incentive is like another boost.
Right. Yeah, and that's too are.
That's the way.
Some of them are probably an area. The part of the waterfront in Portland is probably going to be invested in anyway.
Gotcha.
And
Yeah.
they'll sweeten the pot a little bit.
It's like as long as it cash flows and we know that we're not going to get hurt,
Yeah.
and we can figure out that along the way.
Yeah, and I don't know what they haven't announced what the penalties are, so we don't know how severe those will be really.
How's the state of Maine handling that?
In terms of
Are they following the same guidelines, or are they going
in terms of the benefits,
Yeah.
I haven't read anything that Maine is giving benefits. Usually, I mean, just from a tax perspective, the main tax, your main taxable income starts with your federal taxable income. So if you're excluding something on your Fed return, maybe it gets excluded in Maine, but like the pass-through deduction for under 199A, Maine's making you add that back. So I'd be surprised if they totally conform to it, but I don't know yet.
I would add,
which I know some are well aware of. These tracks, these OZs are very often congruent with new market tax credit eligible areas as well. Same eligibility. So likewise, it's our understanding that you could put a pretty sophisticated incentive stack together that kind of all are legally separate, but can interplay together. From a kind of my perspective in applying for Waterville's OZ, the Growth Council putting that forward, it's been a very decentralized effort. Frankly, that's probably a nice way to say it. And there hasn't been a lot of guidance, and maybe that's some of the public policy analysis on it. Stay tuned for further IRS guidelines and some of these long-term questions subject to legislative cycles. But frankly, like most things, like most tax credits and tax programs.
Yep.
What's the new market tax credit?
The Maine New Market Tax Credit allows you essentially to get some tax benefit on the back end.
I think
That's mostly for job creation.
Job creation, different intent, but job creation and local GDP creation. And there's a difference between the United States New Market Tax Credits and Maine has their main new market tax credits. That tax credit program is managed by CEI. We were talking earlier that this building was bought in conjunction with new market tax credits were used.
Isn't it forced you to get out of the deal at 7 years? It was a required exit prior to the ending.
I believe so.
It gets complicated in that staff.
I think the timelines are a little bit different for those, but that would be something to look at.
The CEI had a big role to play in this bill, basically, with the local New market and historic tax credits that were associated with this.
Yep.
Just to say one thing about the geography of these. So the governor's got to pick, I think 20% of the qualified zones.
Yeah, see, I can't, they were limited in terms of percentage. I can't remember what it was, but yeah, that sounds right.
You got, New York's got 800 of them they picked out of, however, 5 times that, 4,000 qualified zones. The Maine it boiled down to 32. The governor's office, there's a little behind the scenes politics, they finally picked them. So the problem is you get these anomalies, because the thing that drives these zones, they're census tracts. And the census tracts have got income levels identified. So it has to be a low, moderate income zone, essentially. So you get,
or abutting.
Or
abutting.
okay, it could be abutting, right. So I don't think most of them are abutting, but anyway. So you get these anomalies. I'm going to give you the 2 best ones I know in Maine. In Portland, the downtown census, you get these census tracts that have big masses of land, but not many people. So downtown Portland happens to have quite a few people, but it's got when they did the census 8 years ago, it was a lot of low and moderate income people. So the zone that qualified goes from Cumberland Avenue to State Street, to Franklin Street, then up the waterfront in both directions, further. So that's one of the hottest real estate zones in the state right now, and it's qualified. And then if you're State Street if you're Mercy Hospital, now Northern Light Hospital, trying to sell its big old hospital on State Street, it's on the wrong side of the street. And you get these anomalies.
Yeah.
The other one that's incredible is that the zone out in South Portland goes from the airport property line with Portland all the way to Scarborough, because not that many people live out there. Most of them live right on what we call Red Bank, along where the new housing is near the airport. But nobody lives near the mall. The mall's in that zone because they divided the census tract up by population. So guess what? The main mall in Sable Oaks are opportunities. Biddeford got nothing. Saco got the strip along the Miracle Auto Mile.
Wow.
Is in. So the auto mile's in downtown Biddeford.
Anything in Scarborough? Anything in Scarborough?
Yeah, but just a little backstory.
It was really subject upon, in many ways, the communities to put the proposals forward, which I'm not saying that's right or wrong. So, but it takes a relative sophistication to make that argument. And furthermore, the governor also asked, tell us the qualifications and why the determination in which you're doing this, which is unique, right? Usually, say you're looking at that application or that proposal, and it'll say, these are the eligibility requirements to be eligible for this. In this case, the governor said, you tell us what the eligibility is, and you propose this. So I share with you, certainly when I saw the Portland waterfront, I was like, that is incredible.
Yeah.
But we were very excited. I think a little allegory here in Waterville. But to your point, some communities that probably also need it for a variety of reasons. Doesn't mean they were good or bad, just maybe.
Yeah.
I'm not criticizing in any way somebody's fix. It's just there's some anomalies, that's all.
Agreed.
I mean, the fact that the former mayor of Biddeford ran for governor in the primary and said a few things about this little page.
No comment.
They're all set in stone now, though, right?
Yes.
Yeah.
Good. Great. Any other general questions? Well, again, I'd like to say thank you so much to Jim coming up here. So appreciate the expertise, making the trip. We will. Again, all this information will be publicly available on our website. Of course, streamed live. Go back to watch it on YouTube. If you have any questions, feel free to take our contact information. And then again, I think what you heard from Jim, caveat, watch for those IRS regulations, some further public policy questions, some legislative cycles. So keep that in mind. Thank you for joining us. Central Maine Tech Night, the second Thursday of every month. I have my last caveat is the lovebirds in our IT community. Central Maine Tech Night is falling on Valentine's Day next month, so we actually will be a week later in that instance to allow for date night. But otherwise, please feel free to join us then. Great seeing some new faces. Please let us know about follow-up, and thank you for joining us at Bricks. Cheers. Thank you.